Jared Dillian Show.
I'm Jared Dillian. This is the Jared Dillian Show. If you want to call to talk about your money, please call 844-305-7800. That's 844-305-7800. This is the Jared Dillian Show. I want to talk about gold. People have strong feelings about gold. I mean, like really, really strong feelings. By the way, I'm going to publish editorial tomorrow on Bloomberg. Not really talking directly about gold, but I'm talking about MMT and stuff like that. Yeah, there's some. They call these guys, black helicopter people, conspiracy theory nutburgers, stuff like that. There's definitely an element of the gold investors. This is the part. Bought it. Like I can own gold without believing a bunch of crazy stuff. And I just want to say about conspiracy theories. I don't know if I've ever mentioned this. In the finance world where I live, conspiracy theories proliferate. I'm not really sure why that is, but I would say the average trader believes all kinds of crazy stuff. All kinds of crazy stuff. Part of it is the politics. They tend to be right-wing people, but nonetheless, there was this conspiracy theory going around for a long time that basically said that the federal government had this thing called the PPT, the Plunge Protection Team, which is absurd. And they said that if the market was selling off towards the end of the day, the PPT would come in and rally the market into the close. And this just became part of, the mythology. Like people just, it's the PPT. And I'm like, what you guys, do you really understand what you're talking about? Do you really believe that has some guy trading futures and ripping the market? Like, do you really think that? So there's all kinds of conspiracy theories in finance, and I can't get far enough away from them. People just believe incredible stuff. So there is a lot of conspiracy theories when it comes to gold, and I just kind of get away from that. Lots of these folks would like the U.S. to have a gold standard, and the gold standard, I actually agree with that. I think we should have a gold standard, and a gold standard is inflexible. Okay, so that in times like we are experiencing right now, the government loses its ability to do things like quantitative easing. You can't do that under a gold standard. And so downturns would be worse. They would inevitably be, before we had the Federal Reserve, before the Federal Reserve Act, in the absence of the Fed, we had a gold standard. And we had frequent recessions. They were called panics. You probably heard of the Panic of '07. There were several panics, very sharp downturns. But what happened during these downturns is that they recovered very quickly. What we've done in the with the Fed is that we've lengthened the business cycle. We've lengthened the business cycle dramatically. And now the expansions are much longer and the recessions are much deeper. And that's where it's called a flexible monetary standard. That's what we have. We have a flexible monetary standard. So President Richard Nixon took us off the gold standard in 1971. And since then, we've had a lot of inflation. So I would like us to have a gold standard, but I acknowledge that is not going to happen. And yes, I think it is weird that people invest in shiny rocks. And people have invested in shiny rocks for 4,000 years. Gold, we literally have been doing gold a long time. A lot of people say, well, we're a modern society. We have technology and this and that. We shouldn't have to invest in a rock. And yet it keeps happening. And the purchasing power of those shiny rocks has been maintained over time. The purchasing power of those shiny rocks has been maintained over time. Gold has gone up about 4% a year over the last 70 years, basically means it's keeping up with inflation. And that's not bad. That's not bad. If you have an asset that keeps up with inflation, that's pretty good. That's what it's supposed to do. Gold is not really an investment. You don't invest in gold because you think it's going up. Ordinarily, you invest in things with cash flows. Stocks have cash flows. They pay dividends. Bonds have cash flows. They pay coupons. Gold is kind of an anti-investment. You invest in gold because you are worried about stocks and bonds. Gold actually now is almost back to where it was when the crisis started. So a lot of people said that gold performed poorly in the beginning part of the crisis. It went from about 1700 to 1470. And as of today, it's back up to about 1670. So it's almost all the way back. Gold is actually, it's done what it's supposed to do. It has performed pretty well during a crisis. And given the fiscal and monetary actions that we've taken, it's going to perform well long after the crisis. So gold, by the way, from 2009 to 2011, it went from $700 an ounce to $1,900 an ounce. It more than doubled in price. And why did this happen? People bought gold on the fear of inflation. They thought that since the Federal Reserve was doing quantitative easing for the first time, this was back in 2008, they thought that the Fed printing money would result in lots and lots of inflation. So a lot of people were buying gold. The inflation never happened. We never got that inflation. Inflation never went up. Instead, what happened was the gold went up under the fear of inflation. So that was a terrific trade just based on the fear of inflation. It wasn't based on inflation itself. And the same thing is happening today. The Fed is doing not a finite amount of quantitative easing. The Fed is doing infinite amounts of quantitative easing, infinite amounts. And again, the fear is that it's going to result in inflation. By the way, you can print money, but you cannot print gold. And since we are printing lots and lots of money, it stands to reason that an ounce of gold will buy more dollars. Don't think of gold going up in dollar terms. Think of dollars going down in gold terms. That's what's going on here. So there was no inflation back then. Gold also goes up under budget deficits. You can prove this. There's a mathematical correlation. When the deficits get big, that's when gold goes up a lot. The reason gold went up from 2009 to 2011 was also because of budget deficits. We were running massive deficits at the time, 1.8 trillion, 1.6 trillion. Now we are talking about running the biggest deficits ever in the history of the United States, even going back to World War II. And gold always goes up under budget deficits. But the biggest reason to invest in gold is that it smooths out the volatility in your portfolio. Now, at times, I've recommended a 10% allocation to gold, a 20% allocation to gold. Over the last added a small amount of gold to your portfolio, you pretty much had the same return, but it cut the volatility in half. And that's why you should have a small amount of gold in your portfolio. That is something to get excited about. It's not about conspiracy theories. It's not about the black helicopter stuff. It's about better risk-adjusted returns. And what I find that unusual is that all the people who are against gold, I mean, are you really against reducing the volatility of your portfolio? So wouldn't you want something that would magically cut the volatility of your portfolio in half? Wouldn't you like to sleep at night instead of having this breathtaking volatility? By the way, if you owned a little bit of gold during this crisis, you would have a lot less volatility in your portfolio. So now you can invest in actual gold or gold mining stocks. At this particular point in time, it's pretty possible to buy actual gold. Why? Because everybody bought it. Everybody saw the crisis coming and they bought up all the gold in the United States. It's also trading at a significant premium to spot, so you have to pay an extra $200 an ounce just to buy gold. So buying physical gold at this point in time is difficult. You can always buy gold mining stocks. Gold mining stocks, I will say, are very volatile. That's not really going to smooth out the volatility in your portfolio. There's some problems with the microstructure in the gold mining stocks. But you can buy actual gold through an ETF like GLD and IAU. There's a lot of gold mining mutual funds out there. There's some gold mining ETFs. Gold is volatile, but it is usually volatile in the opposite direction of stocks and bonds, which cuts down the volatility in your portfolio. Now, you can invest in physical gold, but just keep in mind two things. Number one, it is just for fun. Investing in physical gold is fun. And number two, you have to be ready to sell. You have to be ready to sell it back to the dealer. People never sell their physical gold. It just ends up in estate sales. I'm Jared Dillian. This is The Jared Dillian Show.
Jared Dillian. Now you know a rich guy. Dillian.